Welcome back to Investing Iguana, where we simplify the complex world of global finance for you. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers. Today, we're diving into an intriguing forecast that's stirring the financial seas across Asia, the potential impact of the U.S. Federal Reserve's upcoming rate cut on Asian currencies. With the Fed hinting at easing rates, there's a whirlwind of speculation about how this could benefit or buffet the currencies of Singapore, Malaysia, China, India, and South Korea. If you're intrigued by the dynamics of international finance and how global decisions ripple through Asian markets, stick around. We're about to unravel the mystery behind these financial forecasts and what they mean for investors and economies alike. The U.S. Federal Reserve's influence. The Federal Reserve, often referred to as the Fed, is a central banking system in the United States. It plays a crucial role in managing the country's monetary policy, particularly through its control over interest rates. The decisions made by the Fed can have far-reaching effects, not just within the U.S., but across the global economy. When the Fed decides to increase interest rates, it essentially makes borrowing more expensive. This has a ripple effect on various aspects of the economy, including the value of the U.S. dollar. Higher interest rates in the U.S. can attract investors from around the world who are looking for better returns on their investments. As a result, the demand for the U.S. dollar increases, which in turn strengthens its value. On the other hand, when the Fed decides to cut interest rates, it makes borrowing cheaper. This can stimulate economic growth as businesses and individuals are more likely to borrow and spend money when interest rates are low. This decision often brings good news for emerging markets, including many countries in Asia. A lower U.S. interest rate means a softer dollar. This is because when interest rates are low, investors may look for better investment opportunities elsewhere, reducing the demand for the U.S. dollar and causing its value to decrease. For emerging markets, a softer dollar can be beneficial. It makes their exports cheaper and more competitive in the global market, which can boost their economies. Furthermore, it can also make it easier for these countries to pay back dollar-denominated debt. Singapore dollar. The Singaporean dollar, often referred to as SGD, is the official currency of Singapore. The economy of Singapore is robust and has strong ties with the United States. This connection is reflected in the relationship between the SGD and the US dollar. The Monetary Authority of Singapore, MAS, which is the country's central bank, uses a unique system known as a managed float system to manage the value of the SGD. Under this system, the SGD is allowed to fluctuate within a policy band. This policy band is not fixed. Instead, it is determined by the Singaporean authorities based on various economic factors. The value of the SGD is closely linked to the US dollar. When the U.S. Federal Reserve, which is the central bank of the United States, changes its interest rates, it can have an impact on the SGD. For instance, if the U.S. Federal Reserve decides to reduce its interest rates, it could lead to a decrease in the difference between the yields of the U.S. and Singapore. This is known as a narrowing of yield differentials. A narrowing of yield differentials could potentially weaken the SGD. This is because when U.S. interest rates are low, investors might look for opportunities to earn higher returns in other countries. As a result, they might sell their SGD holdings, which would increase the supply of SGD in the market and could lead to a decrease in its value. However, the MAS has the power to intervene in the market to maintain the stability of the SGD. If the MAS believes that the SGD is becoming too weak, it could buy SGD to reduce its supply in the market and increase its value. Conversely, if the MAS believes that the SGD is becoming too strong, it could sell SGD to increase its supply in the market and decrease its value. Malaysian Ringgit. The Malaysian Ringgit, often abbreviated as MYR, is the official currency of Malaysia. The Malaysian economy has strong ties with the United States, and as a result, the value of the MYR is influenced by the monetary policies of the U.S. Federal Reserve. The U.S. Federal Reserve's decisions on interest rates can have a significant impact on the MYR. For instance, if the U.S. Federal Reserve decides to cut interest rates, it could lead to a decrease in the difference between the yields of the U.S. and Malaysia. This is known as a narrowing of yield differentials. A narrowing of yield differentials could potentially weaken the MYR. This is because when U.S. interest rates are low, investors might look for opportunities to earn higher returns in other countries. As a result, they might sell their MYR holdings, which would increase the supply of MYR in the market and could lead to a decrease in its value. However, the Central Bank of Malaysia, known as Bank Negara Malaysia, BNM, has been actively managing the MYR to maintain its stability. The BNM has the power to intervene in the foreign exchange market to counteract any significant fluctuations in the value of the MYR. If the BNM believes that the MYR is becoming too weak, it could buy MYR to reduce its supply in the market and increase its value. Conversely, if the BNM believes that the MYR is becoming too strong, it could sell MYR to increase its supply in the market and decrease its value. Chinese Yuan. The Chinese Yuan, often simply referred to as the Yuan, is the official currency of China. Despite various negative headlines that China has faced, the exchange rate of the yuan has remained relatively stable. This stability is largely due to the expectations set by authorities that the yuan will not be allowed to weaken below a certain level. China has made attempts to stabilize the yuan against the US dollar. This is a strategic move aimed at maintaining economic stability and ensuring that the value of the yuan does not fluctuate too drastically. The stability of the yuan against the dollar is crucial for both domestic economic stability and international trade relations. The expectation is that China will continue to stabilize the yuan against the dollar. This means that the Chinese government and its central bank will take necessary measures to ensure that the yuan does not weaken significantly against the dollar. These measures could include interventions in the foreign exchange market or adjustments to monetary policy. The exchange rate of the Chinese currency is likely to remain in a narrow band around the current rate of 7.10. A narrow band means that the value of the yuan will not fluctuate too much above or below this rate. This is a common practice in managed exchange rate systems, where the central bank intervenes to prevent the currency from appreciating or depreciating too much. Indian Rupee. The Indian Rupee, often abbreviated as INR, is the official currency of India. This year, it could potentially benefit from a financial strategy known as carry trades. In a carry trade, traders borrow money in a currency with low interest rates, such as the US dollar, and then use that borrowed money to buy assets in a currency with higher interest rates, like the Indian Rupee. This allows them to benefit from the difference in interest rates, which can lead to significant profits. Carry trades are a popular strategy in the foreign exchange market, and they can have a significant impact on the value of currencies. If many traders are using carry trades with the Indian Rupee, it could increase the demand for the rupee, leading to an appreciation in its value. In addition to the potential benefits from carry trades, the Indian Rupee could also strengthen due to expectations about the monetary policy of the Reserve Bank of India, RBI. The RBI is India's central bank, and it has the power to influence the value of the rupee through its monetary policy decisions. If the RBI is expected to loosen its monetary policy more slowly than other central banks, it could lead to an increase in the value of the rupee. This is because a slower loosening of monetary policy could mean higher interest rates in India compared to other countries, making the rupee more attractive to investors. South Korean Won. The South Korean Won, often abbreviated as KRW, is the official currency of South Korea. Over the past 3 years, the KRW has been under significant pressure due to various economic factors. However, the outlook for 2024 is more positive, with improving economic prospects and changes in the U.S. Federal Reserve's policy expected to ease this strain. The U.S. Federal Reserve's policy, particularly its decisions regarding interest rates, can have a significant impact on currencies worldwide, including the KRW. When the Fed loosens its policy, it often involves lowering interest rates, which can make the US dollar less attractive to investors. This can benefit other currencies, like the KRW, as investors may seek higher returns in other countries. In the second half of 2024, the KRW is expected to be one of the major beneficiaries of the Fed's easing cycle. An easing cycle is a period during which the Fed is reducing interest rates to stimulate the economy. This can lead to an increase in the value of the KRW as investors may move their investments from the US to South Korea to take advantage of higher interest rates. Furthermore, the improving economic prospects in South Korea are also expected to contribute to the strengthening of the KRW. Economic growth, stability, and positive future outlooks can make a country's currency more attractive to investors, leading to an increase in its value. As we wrap up our journey through the potential impacts of the Fed's rate cut on Asian currencies, remember, these financial forecasts are not just numbers on a chart, they represent the pulse of economies and the livelihoods of millions. The upcoming decisions by the U.S. Federal Reserve could indeed be a game-changer for Asian currencies, offering both challenges and opportunities. If you found this analysis insightful, make sure to hit that like button and subscribe to Investing Iguana for more clear-cut financial insights. Got any questions or thoughts on how these changes might affect your investments or the broader economy? Drop a comment below. Let's keep the conversation going. Until next time, stay savvy, explore wisely, and see you on the next financial adventure.